Welcome, ladies and gentlemen, to our regular 6-minute strategy summary from me, Guy Munson. Last Friday marked the one-year anniversary of Vladimir Putin's war against Ukraine. Our hearts are with the country's exceptionally brave fighters and the heroes we see every day. The onset of war a year ago triggered extreme geopolitical, energy and food supply shocks around the world, and particularly in Europe. Together these threatened a global recession and a deep contraction in industrial production. Thankfully, though, these worst fears were never realised. Indeed, energy prices have now subsided and extraordinarily now trade at levels below those seen on the eve of the crisis a year ago, while wheat prices too have largely normalised. Indeed, global growth has been impacted much less than we dared hope for, and it looks like we may now avoid technical recessions in Europe, the UK and the US. For this we must credit the dramatic reopening of the Chinese economy and the pivot achieved by Europe in diversifying away from Russian gas. Indeed, the greatest threat to markets today lies not in global recession, but in further overheating despite a string of interest rate rises. We'll look at these developments in more detail in the slides ahead and see what it means for investment policy 1 year on. So let's begin by looking at global asset prices over the last 12 months in that left-hand panel. You can see indexed at 100, that surge in oil, that's the yellow bar, up by almost 30% in the first few months of the war, but then remarkably beginning to decline and ending the year almost 20% lower than where it started. Extraordinary given the global embargoes that we've seen. For other asset prices, global equities and gold off about 5%, about what we would have expected. The real pain coming in bonds, US Treasuries and gilts down by about 20%, as bond yields surged by almost 200 basis points. Obviously as a result of a steady drumbeat of US rate increases, see that in green, despite the impact of the war. On the right-hand panel, I've split those global equity numbers out by regions, and we see another remarkable outcome. About 5 to 6% declines in American and Asian equities, but extraordinary 10% gain in European equities, the supposed epicentre of the terrible crisis that we've seen. How is this possible? We've talked about this many times on these videos before, but it's the remarkable pivot away from Russian gas. In the left-hand panel, I've shown what this has meant for Germany. This left-hand panel is gas consumption in terajoules. Each of those spikes the really cold point in December, January, normally hitting around 500,000 terajoules. This time consumption has peaked at 380,000 terajoules, a more than 20% fall. And this has been achieved with no noticeable reduction in industrial production and nothing near a recession in the underlying economy. Extraordinary efficiency gains. On the right-hand panel, you can see what this has meant for gas prices. At one point, we saw gas 250 to 300% higher. It's actually ended the year 27% lower than it was when the invasion started. And that slightly flatters the number because there was a big run-up in gas prices in the few months ahead of the war, but still the numbers are extraordinary. Not only have they helped global growth, but for hard-pressed exchequers and public finances, as we've seen in Britain, they've transformed the cost of the subsidies that were needed. Oil prices too have been beneficial. Brent and WTI have continued to fall, whereas this one on the one side, of course, the Chinese COVID lockdown until a few months ago meant much lower Chinese oil demand. You can see in the left-hand panel at 2.19 million, that's well above trend, that red line. The other factor, of course, was the very aggressive use of the Strategic Petroleum Reserve by President Biden. He released almost half the reserve, that's around about 350 million barrels, the largest release since the reserve was started back in 1983. Now he's going to have to rebuild that at some point, but you can see the effectiveness in controlling global oil prices. The third factor we have to thank for the muted impact of the war is now the Chinese reopening. You can see GDP in that left-hand panel split down a very, very low, almost 3% in 2022. And the real factor that contracted was that green bar, consumption. Well, as we've seen in Europe and the US, when you do reopen, consumption tends to take off very dramatically. So we think that GDP number will come sharply up to 5% or more. And on the right-hand panel, that blue bar Chinese growth will be back supporting the global economy. So very positive. The fourth and final factor is that despite all these challenges, the war and the energy shock, the US continued to barrel along. We thought things were beginning to slow sharply last month. The services PMI, that's the famous ISM survey, that red bar dropping below 50. But then in the last month it surges back up to 55, showing strong expansion. Labour market's very robust, the unemployment rate at 3.4%, a 53-year low. Retail sales strong, you can continue listing the numbers. So ironically, as we look at the market impact of the war, the real challenge for investors today is not impending recession, but economies that are still too hot around the world that will need higher interest rate increases. You can see this in the US, Chairman Powell battling with this red-hot labour market. I've just come back from New York. You can see we're about 4 million employees short of what we need to balance the labour market in the left-hand panel. And on the right-hand panel, of course, these stronger investment markets actually mean that financial conditions are easing, which makes the Fed's job more difficult. So where do we now stand at Saracen? Well, having seen a very nice run-up in global equities, which we've participated in well, we are modestly underweight today. We think some of those risks of the war are still there, geopolitics are deteriorating, and of course interest rates are continuing to move higher as the US economy continues to barrel forward. So a little bit of caution, perhaps buying into bonds at these yields over the next few weeks and months, and where appropriate, using portfolio insurance to protect against a geopolitical crisis. Well, I hope that's helpful, and from all of us here at Saracen once again, our hearts go out to all of you in Ukraine and your remarkable bravery and heroism. Thank you.